I'm a macroeconomist, mostly by decree. And so when I'm at these macro clubs and these macro circles, and we're hanging around and we're talking about who our favorite macroeconomists are, this is true story. Unambiguously, I will say Gary Becker, Kevin Murphy, and Bob Topel. Okay? And a lot of my students are in the class now, and I'm in the macro sequence. I teach as part of the macro. In our reading list, there is very little Barrow, essentially no Lucas, but there is a heavy amount of Murphy, Topel, and Becker. So, and the reason is I am interested, or at least some of what I'm interested in, is going to be the evolution of employment over periods of time. Okay? And the stuff David works on quite often, also on my reading list quite heavily on the macro. I know that embarrasses you to know to know Ed embarrasses you on a macro reading list. So, but what we've been thinking about a lot over the last decade or so, is changes in employment to population ratio, and a lot of macroeconomists are thinking about it. And we, in this paper, are trying to revisit this question. So we have like two kind of papers floating around, and I don't know how we're going to merge them together. So some people might have shown an older version called Manufacturing Decline, Housing Booms and Non-Employment. We're kind of moving to something called Housing Booms, Labor Market Outcomes, and College Enrollments. I'll tell you how they're all related. I'm going to kind of give you a sense of both of them today, and I'm not sure how we're going to package them ex post. Oh, and this is all with, Matt Nadawigo, who you saw earlier today on the 10-care paper, and with Kerwin, who you saw earlier today on the stuff with John Gurian on gender and culture-ish type stuff. Okay. So what did we do in this paper? Here's the question. I want to try to understand how changes in the manufacturing sector, thinking about it almost as like a sectoral shift. We've kind of talked a lot about sectoral shifts for decades now. But we have a big one. I'm going to show you some data on this in a second. David's kind of influenced, kind of shown a lot of this in his work. Massive declines in manufacturing that have occurred in the recent decade. Okay. Simultaneously, we've had massive increases in something called the housing sector. I don't know what's driving that. We've got to think about that. And a rapid correction that occurred relatively quickly. Okay. And I want to try to think about, one, what is the independent effect of each of those changes on labor markets during the recent period, 2000s through today. I want to see how they interacted, and then I want to see if they had any effect on the normal way we adjust to sectoral decline, particularly for low-skilled workers, skill acquisition. So that's kind of what this paper is going to be about. So just for those who are unfamiliar, and again, David kind of shows this in a lot of his work, is there was a massive decline in manufacturing employment within the U.S. in the early 2000s. We know the manufacturing sector has been eroding for, a couple of decades. From the early 1980s through the late 1990s, the U.S. economy lost about 1 million jobs in manufacturing. The share of people working in manufacturing kind of fell sharply. Why? Because population was growing. Okay. But in a short time period between early 2000 and 2003 or 4-ish, okay, we lost 4 million manufacturing jobs during that period. So there's a tremendous amount of dislodging of the workers in the manufacturing sector. That trend has continued through the recession, post-2007, and you see that they talk about the rebound on manufacturing that's going on. That's epsilon relative to what we've lost during this decade. So we have these big declines in the manufacturing sector. Okay. So specifically, I already told you kind of what we're going to do. We're going to think about the manufacturing sector. We're going to think about the housing market. We're going to try to estimate the individual effect of those on labor market outcomes, employment in different sectors, wages, population movements potentially across places that produce these types of sectors. And then we're going to talk about how things have interacted as a result of these. What is it like to have a manufacturing decline in a labor market where the housing sector is booming at the same time? Again, we got to talk about why the housing sector. God doesn't come down and lift a housing market. It's a price. It's determined by market. We got to think a little bit about that. And then we're going to ask ourselves, what would have the employment situation looked like in the U.S. prior to the recession, prior to 2000, had there not been a housing boom? Okay, how much did the housing sector add to the economy during this time period? Okay. And then we're going to talk about the effects of these changes in housing markets and manufacturing on skill acquisition. And we're going to do so using a local labor market approach. We're going to have to think about some general equilibrium effects as we talk about. And then we're also going to do it pre-recession and post-recession over time period. So I think the best way to get into this paper is to kind of show you what I do. Okay. Just to let you know what our findings are, that the manufacturing decline did reduce wages during this time period. David's kind of showed this with his China component of the manufacturing decline. And it reduced employment for low-skilled workers, particularly low-skilled workers, during the early 2000s. Almost all of this, a bunch of this, occurred prior to the recession. So the labor market was a lot weaker prior to the recession for low-skilled workers than we might have been talking about the cyclical variation that we would have seen in the during the 2007 to 2000 current period. Okay. Why didn't this show up in aggregate statistics? At the same time, there was a demand shock, a labor demand shock for low-skilled workers through housing-related sectors, particularly in construction for men, and a little bit of construction in other sectors for women. Okay? So the labor market was kind of lifted during the early 2000s because of this housing boom. It was kind of depressed because of the manufacturing decline. The recession comes along, manufacturing continues to decline, the housing sector corrects, and we're left with a bunch of workers who are on the sidelines with low wages. Okay. And then I'm going to show some stuff that there was a kind of a decline during this period of the housing boom in human capital attainment for both men and women, starting in the late 1990s through pretty much the 2007-ish period, where things look like the trends in human capital attainment seem to break trend around that period, and then reversed somewhat after the recession. And I'm going to show you that these trends kind of broke in places where the housing boom was the biggest relative to the places that didn't. And we're going to talk a little bit now about how this housing boom might have slowed down a little the adjustment that normally would have occurred to a secular decline in the demand for skill for low-skilled workers. And that's what this paper is going to be in a nutshell. So now everything else is just the nitty-gritty. So let's kind of get into the nitty-gritty to kind of have a discussion of what we do, how we identify what we do, and I'll go from there. Okay. So I'm going to kind of put some structure on this econometrically in a little while, but you're just going to think we have these islands. I'm going to treat them as islands. Okay? They're going to be metropolitan areas. There's going to be some labor market outcome in that island. Okay? K is going to be the island. L is going to be some labor market outcome that might change over a period of time, like 2000 to 2007. Labor market outcomes of interest are going to be things like employment rates, okay? Wages, employment in a given sector, okay? Population. Okay, so these might be migration across these islands. The labor market in that island is going to be determined by a bunch of labor demand stuff and a bunch of labor supply stuff. Where I'm going to try to decompose the labor demand stuff, realizing that there's going to be some potential interaction between things that happen in the manufacturing sector, things that are going to be happening in the housing-related sector. I'm going to try to talk to you about, a lot of what I'm going to talk to you about is how I'm going to try to identify this. And then some error stuff, some things I'm not going to measure. What am I not going to measure? Things that are happening in other sectors in terms of labor demand, and anything that could be happening with changes in labor supply. Yeah, I'm going to show you, we're going to allow, there's not much interaction in between the sectors on average, but I'm going to show you there is some for individual workers if they happen to be in an island that happen to have a manufacturing shock and a construction decline, they get both of those. So their labor market outcomes are different, but it doesn't accelerate. There's no multiplicative response between that. It's like the interactions don't add anything to the individual effects. So there's no differential price in one. But there's a price effect that's equal to any other place that had a housing effect, and there's a price effect that's equal to any other place that had manufacturing. And those islands that had both get both of those additively. Okay. So what we're going to do for the manufacturing sector, I'm not going to spend any time on this because I think it's familiar to most. I'm going to be using, okay, this is very poor language, but I'm going to use it in one step just to kind of explain to people who are partially familiar, and then I'll kind of give credit where it's due, as Bob likes me to do as well. Kind of a Bartik type variation where they have initial industry mix interacted. Hey, I'll give you 1 second, I promise you. I'm going to give you 1 second. I'm building up to something that's kind of nice. Okay, I don't do that often. So where it's basically initial industry share interacted with national changes in employment in those industries at the 3-digit manufacturing issue. Now, Bob and Kevin have done this well before Bartik, and Bob has been telling me for about 2.5 years, that Finance has done it even before that Bob and Kevin did, and then they got it for Finance. And Bob sent me the paper last night from 1970 where Jim and Finance have used this kind of shift share type of analysis where you have some initial industry mix in the location interacted with national trends. Yeah, okay. So,
any kind of index creation.
Yeah.
Just assume Finance did it before you.
Yeah, that's what I did. So this is kind of what I'm not going to spend a lot of time on this. But in this period during the 2000s, the places that got hit hardest in manufacturing ex post were the places with the biggest manufacturing share ex ante. So Detroit had a very big predicted decline in manufacturing, and ex post it actually had a very large decline in manufacturing. If you just use the prediction from this kind of shift share analysis against the actual changes in manufacturing, it's got a slope of 1. Okay, it's a pretty strong predictor during this period as it has been in other periods. So that's going to be my housing. From now on, when I talk about predicting housing demand shock or manufacturing demand changes, that's what I'm going to be using. Okay. So now what we're going to talk about is how am I going to think about the housing market. So I'm going to put a little bit more structure on the housing market, and then we're going to try to think a little bit of instruments to try to think about for what's going on in the housing market, because housing markets are endogenous to lots of stuff, and we'll try to formalize that in a little while. So in the back of your mind, just kind of think about what I'm going to try to make is a housing demand shock on a given island, and then we'll try to see how we're going to instrument for that in a little while. But the housing demand shock in the island, we're just going to use a little bit of simple theory. There's going to be a housing demand equation, a housing supply equation on each island. Okay? And then we're just going to try to back out, using the data that we observe, what this housing demand shock is going to be. So just think we've assumed, again, that God created the world in somewhat of a log linear way, and that housing demand is going to be some elasticity with housing prices and a shifter. Housing supply is exactly the same. So just with a little bit of algebra, writing things in a different type of way, you could back out the housing demand shock on an island with the assumption, there's a big assumption, I'm going to have a few assumptions going through to take this data, that there's no supply shocks that are different across the islands. Okay, assuming there's no housing supply shocks, you could back out the housing demand shock is just going to be a sum of the demand elasticity and the supply elasticity and a given price change. So some places that had a big price change either did so because they had a big housing demand shock and they were pretty inelastic, or pretty elastic, or they had a small housing demand change and they were relatively inelastic. That's kind of the essence of that. Now, a lot of this I could get by island from the data. Changes in house prices, I could measure island specific. I'm just going to take that from repeat sales industries. Other people have tried to measure housing supply elasticities on an island, how difficult it is to build based upon zoning type regulations and topology type of variation in the data. So I'm going to use the estimates that others have tried to construct in the literature, saying it's harder to build on a hill than it is to build on a flat land. It's harder to build in areas where you have to, go through a lot of bureaucratic hurdles than it is in places that have to go in less bureaucratic hurdles. So that's going to be measured from the data. My housing demand elasticity, I'm not going to have variation in that in the island, so I'm just going to pick a number that comes from the literature that they did for the U.S. as a whole, assume it's island specific, and then I'm going to do robustness. So there's a whole bunch in the paper I'm not going to talk about today. Suppose how that varies and potentially what could it be correlated with, okay? And this is going to be the demand for, I think it's going to be the flow, right? It's going to be our housing. How much you're going to...
Demand for construction or demand for holding?
It's going to be for the new kind of construction of housing. I'm going to show you when I come in a second. That's what I'm going to be using in the model. That's what's going to be there. So I'm going to formalize some of it, but they're going to have a measure in a second. I'm going to show you it seems to be correlated with lots of stuff, this measure, and then I'm going to try to instrument, because again, God does not come out and create housing demand shocks on islands. Okay. So before we get to that, let me just tell you I'm going to use census data. I'm basically going to use this in different types of periods. I'm going to pull down the census in 2000, pull together 2005 to 2007 data from the American Community Survey. I'm going to call that 2007. And then I'm going to pull together 2009 to 2011 and call that 2011. Why? I need enough observations on the islands to try to mitigate some island-specific measurement error. I'm going to look at 21 to 55-year-olds. Sometimes we'll slip into saying prime age, but that just means no offense to anybody. I just put myself in the middle range of any age range that I'm looking at in the data. So that's kind of what I'm looking for. Okay. So here's what I'm going to run. Okay. So we have these two equations. There's some labor markets on an island. Okay. You see the separability assumption I'm opposing here, but we've tried a bunch of interactions. Is that some labor market outcomes are going to be a function of the manufacturing demand change, basically this mission wealth variable, the housing demand change on an island, some controls, and some error. Okay. We realize that the housing demand shock is going to be determined by stuff. Things that are going to determine housing demand might also determine labor demand. Okay, some of those might be the manufacturing change itself, the other demand shocks, maybe some labor supply shocks. Okay. We're then going to have to think about when we interpret the manufacturing effect on an island, it might be its direct effect through the labor market and any indirect effect that it has on the housing market. So we're basically then going to want to think now about what potentially could move housing demand on an island that might be unrelated to some of these other manufacturing or other sector type changes. Okay. And again, we know why we went there. First of all, there's measurement and error in my housing demand measure, but we just, as I said before, housing demand is endogenous to stuff. So what are we going to use? Okay, and this is what you should push back on, but I've slept a little better at night ex post than I did ex ante, and I'll show you why that is. We're going to take a look at these sharp structural breaks that occurred in housing prices in some markets right around the mid-2000 period. Now, as a Chicago macro guy, I have to, sign a little waiver saying I don't believe in things like bubbles ever. But ex post, I look at the data, and there's kind of weird things going on in some housing markets that happen in a very short period of time that seem uncorrelated with anything, that seem to revert ex post. And what I'm going to be using now is kind of these structural breaks in these types of markets to try to identify the housing demand shock, with the implicit assumption that the labor demand stuff happens at a much more gradual pace than what we see during this time period. Let me just show you kind of what the data is going to look like in some markets. Here's two cities with exactly the same housing price increase between 2000 and 2006, one of which did nothing to 2004 and then spiked between 2004 and 2006, Portland, Oregon. The other, New York City, kind of steadily increased over this time period. Okay? There's a bunch of cities that look like this. Phoenix, around Bob's, summer, winter, vacation, weekend home, Ocean, New Jersey. Same thing. Nothing happened in Phoenix, and then it shoots up. There's many cities that kind of look like this pattern over time. So what we're going to do is we construct the instrument in the following way. Okay, we're basically going to use these housing price data from the mid-1990s through the mid-2000s to try to see if we could identify a structural break in the data in this house price series. We're going to use the location of there. You can choose this location of that structural break to maximize the R squared of the regression at this time period, and then we're going to use that R squared as basically going to be our instrument. Okay, and so you basically got to think now that the areas that have the biggest predictive power are going to get, in the structural break, are going to get a higher value than the ones that don't. Okay, so that's going to be our instrument over this time. So you think about in the data, there's three types of variation: places that had no house price variation over the whole time period, places that had steady house price over the whole variation, and places that had this very discrete jump in house prices over the variation. And we're going to use the variation about the discrete jump relative to the other two when we're estimating the effect of housing markets on the economy. Now, just so I could see, this is our structural break instrument and our demand shock. Okay, they're highly correlated. The places that had what we're going to call a higher demand shock also happen to have a higher structural break in the data. Now, one thing you might be concerned about is, again, does God come down and create structural breaks? Maybe, maybe not. In a bubble story, I don't know where they come from. But is it correlated, this structural break, with anything else we could observe in the data? We couldn't find much that we played around with. So this is basically the structural break and lagged housing price growth. There was nothing. Again, each one of those are islands. The size of the island is the size of the circle. Housing supply elasticity. Other people have tried to use housing supply elasticities as a potential instrument. Okay, what we found in the data is that the places that were the most inelastic had the biggest construction booms during this time period, which kind of tells us that maybe something else was going on in these islands besides just the God-given inelasticity, but doesn't look like it's there. What about non-employment rates in 2000? There seems to be no correlation. Wage rates, doesn't seem to be any correlation. Okay. We did find one thing that it was correlated. This was given to us by some finance guys, that the amount of out-of-time borrowers is something that people have used as a measure of bubbleness. We only have this for 21 cities for the guys who put this data together, the finance guys, but there might be a correlation there. Again, it's 21 points. I don't know how much I put in, but it looks like maybe. I don't know. And here's what I do know it's correlated with, the bust. So right now it's just without an instrument. Just every place that had big booms during this period had big busts. Okay? And our instrument is highly correlated with the bust in housing prices between 2007 and 2010. So we're going to use now kind of this structural break to think about something, like something weird happened in the housing market that was otherwise unrelated to local labor markets at this time period as our instrument for housing demand. Okay. So again, there's a first stage that's good. You guys could believe me on that. You don't have great, I mean, I could try to make data on rental prices, but exactly, if the price to rent ratio. Yeah, price to rent. Yep. 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 So I should look at it. It's, yeah, yeah. So we could look at the thing about the rental things. It's always hard to get repeat sales into holding quality fixed. But I could try to do that in the sense that there's nothing that prevents me from making my own rental price index, try to control for some sort of, structure characteristics and kind of see what it is. It's not going to be as clean as the repeat sales indices in the house price data, because you don't have repeat sales, repeat rental properties easily gettable, but I could play around with it, because you want to see that kind of see if there's something about the price to rent ratios that are moving around. Okay. So kind of what do we get on this? So I'm going to basically now start, what?
Interest rates.
Yeah, but interest rates don't vary spatially.
Well, effective terms, I mean,
yeah.
Yeah.
Yeah, I'm going to show you another paper, probably this winter, where I'm now looking at spatial variation in interest rates in the sense that there isn't no spatial variation, and how that kind of leads to some regional risk sharing. But I put together a bunch of stuff, at least for government securitized mortgages. There's no spatial variation across these islands in mortgage rates for different projects. But that would be great if we could have something like that, if there was such variation. Okay. So what we now is basically going to just look at non-employment rates, so the propensity not to work for different groups, non-college men. When I say non-college men, these are men without a 4-year college degree. Okay, so some college are in these bins. College men are 4-year degree or more. Then you have non-college women, college women, and all. And a couple things I want you to draw your attention to. A 1 standard deviation manufacturing decline increases non-employment for non-college men by almost a percentage point, a little bit under a percentage point. Notice it's much smaller for college men and college women. Okay, why? Because they just don't work in manufacturing as much, and maybe they're more elastic for those who do. The housing shock tended to affect non-college men much more than it did the other groups. Okay, college women don't work at all in these construction-related things. There was no response whatsoever. Non-college women and college men did respond some as well. Now, one thing you could ask is how much is the construction response itself responsible for the change in non-employment for people in islands with a housing boom? And for men, it's essentially 100%. These are places where construction went up by a lot, okay, and that absorbed those workers during this time period. For women, and these are in our IV estimate, it's about 40%. Okay. So a little bit of women into these construction industry. But what are the women in these housing boom cities doing? I have some colleagues here in the finance group at Chicago showing that local property booms kind of have spillovers on local non-tradables broadly. We get a little richer, we go out to restaurants, we go to a restaurant, we need a new waitress, and that's kind of absorbed some of the employment in those areas. Okay. Okay. So we do a bunch of other stuff that I'm just not going to say for time because I want to show you a couple stuff on the education results. But we kind of look at the wage response, and you could get the wage response as a result. It gives us applied labor supply elasticities that aren't crazy when you look at the wage response and the non-employment rate of about, minus 0.3, minus 0.4, which on the extensive margin, I don't know, is on the upper range of what people have given. It isn't crazy. The manufacturing declines result in larger non-employment increases for old workers relative to young, so the old guys are getting hit really hard. Okay. The housing demand increase results in a larger non-employment response for immigrants than non-immigrants. There's still some response on the non-immigrants, but you see a large response on immigrants. Particularly young people. I should have put it in there. The young people respond a lot to the housing demand relative to older households. The decline in the manufacturing, and David showed this in his other work, has resulted in an increased public assistance on these islands, potentially explaining why the non-employment results are going on. And then we estimate migration response across the islands. Okay? And it's not surprising. Islands that got hit with bad shocks had out-migrations. Islands that hit with good shocks had immigration at the same time.
What happened to service activity? You look at the other
I've looked at, so I could do the service set. So I've tried to look at retail versus, other services. I just didn't have enough power. So you can kind of see they both kind of moved in the direction of a housing boom where things increased, but I didn't have enough power to distinguish whether one increased relative to the other. Okay. I just want to show one other interesting result. I'm going to then tell you one thing we did, and I'll get to the human capital stuff. The first thing I want to show is if we look over the decade as a whole, okay? So from 2000 to 2011, using our shocks that are defined from 2000 to 2007, okay, the manufacturing decline, the housing shock. The manufacturing still has a persistent effect a decade later. The housing booms have much smaller effects on employment over the whole decade than they did only during the boom period. Why? Because most places that had a boom had a bust. And what happened now, a lot of the housing decline on employment that other people have identified is just undoing the housing boom positive effect on employment during the boom period. So the effect on employment over the whole decade as a whole is much smaller from the housing boom than it would be if you just look at the bust. And that's something, when people start talking about policy responses of propping up housing, they see a correlation in the data that places that had big housing declines had big employment declines, but they fail to recognize that the places that had the big housing declines are also the places that had the big housing increases that raised employment over this time period. Okay? So we do a lot of stuff, and I use this. I don't know if I like this word. I don't know. I like it sometimes more than others on our paper, that there's some sort of masking response of the housing boom to the manufacturing decline. Okay? And that occurred across people, across space. But the one thing we look at is we use data from the Displaced Worker Survey to ask for an individual worker who got displaced in manufacturing. Were they more likely to be reemployed if they happened to live on an island with a housing boom than an island without a housing boom? And the answer is unequivocally yes, by a large margin. Okay, like a 30% more likely to be reemployed on islands that had a housing boom at the same time they got displaced in manufacturing. And more so, they are much more likely to be reemployed in construction, which isn't crazy. Now, not a lot of manufacturing workers move to construction, but conditional on moving to construction, you're much more likely to move to construction in an island that had a housing boom than not. So we see, even within a given individual, there's some of the interaction between housing booms and manufacturing decline on these islands. Okay, we do a bunch of counterfactuals, and this is my macro side. There's a whole bunch of grain of salts because we could do some general equilibrium stuff, but not a whole bunch of general equilibrium stuff. But some of our counterfactuals say the declining manufacturing that we observed during the 2000s, in the ballpark, could explain about 40% of the increase in non-employment in the U.S. as a whole during this time period. Okay, and if you add up jobs, it doesn't look crazy. I mean, we lost a whole bunch of jobs, and that 40% is like, a subset of those jobs that were lost in manufacturing. Okay. The housing boom in the pre-period raised employment rates by about 1 percentage point on the upside. Okay. Non-employment, yeah, so I might have got housing boom raised employment, yeah, lowered non-employment. Yes, this is me writing slides. Yeah, yeah. So during this time, so the market was doing, the labor market was weaker in 2007 if it wasn't for this housing boom that absorbed some of these the low-skilled workers. Okay. We bound the estimates using mobility. We discuss other general equilibrium stuff, which adds to our grain of salt. Okay, let me just show our last picture and then tell you what we've done quickly and what we are ongoing doing, and then I'll conclude. So many of you have seen pictures like this, that the propensity for a young individual, and here I define young, 18 to 32. I should change my slide up there. 18 to 32 with 1 year of college. Okay, this is just the definition of going 1 year. Women on the red, men on the blue, both increasing over time until you get to the late 1990s, early 2000s. It's kind of flat until the recession and kind of going back towards trend. We might ask, how much of did the housing boom during this period actually deter young workers who were entering these construction and related industries, contribute to the decline in education? So what we use now is a bunch of data from two sources. Okay, I'm going to describe one here, and I'll tell you what we're currently doing in a second. So we use data from the college enrollment data at local levels. We aggregate up how many people are enrolled in college, and then we ask what happened to enrollments in college in markets that had big housing booms versus markets that didn't have big housing booms. The manufacturing stuff didn't do much. Okay, but the manufacturing stuff hit old workers more than young workers. The housing boom hit the young workers. And what we find in places that had these big housing booms, Las Vegas, Phoenix, you saw much larger declines in college enrollments than in places that didn't have those housing booms. Okay, and almost all of the decline is on two-year colleges and trade schools with no effect on four-year degrees or graduate schools, which we could imagine would be the right way. They're not on the margin. These guys go into construction just on the margin, aren't on the margin of going to graduate school. And from this, we could basically explain somewhat of half to a little bit over half to two-thirds of the decline in college enrollments for both men and women relative to trend could be explained by the housing boom over this time period. Again, with the same general equilibrium caveats that we had before. We're doing stuff now using different data from the censuses to then track cohorts over time. And some of our preliminary results is that the rebound that we're seeing in Las Vegas now are going to be new cohorts, young cohorts entering, not the old cohorts who foregone the education when they were in their late teens and early 20s. So those people just are less responsive, as all of us have seen in many richer.
Shouldn't be finding much effect for women.
You find some effect. It's a smaller effect. I mean, the decline is small. So it's a 70. I mean, here you can see these are in percentages. The effect for women is smaller, and then when I scaled them by the trend, that was there. But we find some effect for women in these local markets as well. Yeah, that's what we tried to estimate the spillover effects before. Yep. Yeah. Oh. Yeah, and so we find some of that. Okay, so this is, I think I'm close to over my time. I think Kevin gave me a minute. I'm way over. I apologize. I apologize. Bob deferred some time to me, but I think I took more than his time. And oh, look, I broke the clicker. Yeah. So the key thing is that I want to say is that sectoral declines are an important part of thinking about the weak labor market. You know, you could read the slides there. The one thing I did want to say is the stuff that Kerwin and Noto and I are working on now is kind of the skill substitutability in thinking about why sectoral declines in agriculture might have had less of an effect on labor market outcomes at the beginning of the last century relative to the sectoral decline in manufacturing. People who leave agriculture could more easily get absorbed by the manufacturing sector. The people who leave the manufacturing sector might have struggle moving into both high-end services in particular, but even low-end services. So we might want to think about that. So Kerwin and Noto and I are working on that next. I broke your clicker, Bob.
I don't think I need it.
Okay, for you.
I really like this paper. It's got at high altitude, which is the way I'll discuss it, it's a pretty simple idea that there were, let's call them technology-driven demand changes over time that were unfavorable to people in a particular part of the skill distribution. And that manifested itself a lot in terms of a decline in the number of people we need to make a ton of steel. That reduced the demand for labor in the manufacturing sector. But, you know, guys who make refrigerators can build houses. It's in a broad sense, it requires similar skills. And those people or people like them found a home in the housing sector. So at some level, it's giving the reasons, and I find the argument compelling. It's giving the reasons why in some places the decline in the demand for less skilled people was more muted, and in other places it was stronger. Now, it's kind of an old problem, so that many of us here have had some hand in over the years. So what accounts for the rising non-participation rate? David's worked on some stuff with regard to supply side things that made non-participation more attractive. Many of us here have worked on demand side things. One, there was a big shift towards, a simple fact is there was a big shift towards full-time withdrawal from the labor force. I'll show you a couple pictures in a second. Second, the increase in non-employment and especially withdrawal from the labor force among men was highly concentrated at the bottom of the skill distribution. And at least until the mid-2000s, there were sharp wage declines in exactly the part of the wage distribution where people withdrew. So I view this paper as sort of putting in context another piece that tells us why those things happen. So I'm going to show you a couple of graphs from some stuff that Kevin and I did with Chinhee about 10 years ago. Got to find it first. So here we go. Data, la-da-da-da-da. One more page. There we go. Here's a picture that we've all, many people in the room have made. And it shows the evolution of wages since 1970 for people in different parts of the skill distribution. And the people at the bottom were taking a real hit, down by about 25 log points, out to about 1993. After which time, across the skill distribution, things kind of bounced back. And up until this work we did was only up until 2000. But you notice the big uptick, especially in the upper half of the income distribution. So one of the questions I had, this paper treats housing booms and even housing busts as sort of an exogenous event. And much of what I would think is going on here is that given the increase in the returns to skill that drove demand for better places to live at the top of the income distribution, the guys at the bottom were building houses for the guys at the top. And the places that's going to matter the most is when supply is most elastic, I think. If I go down a little bit farther here, if I can make this thing work, go down to page 107. This is what I want, yeah. Here's, we estimated, or we calculated non-participation rates for people in different parts of the income distribution here. So I showed you the wage stuff, and what you've got is the middle panel here is non-participation, the bottom panel is non-employment. Now most of those changes in non-participation, as I mentioned before, are accounted for by people who are just withdrawing from the labor force. So back in the early 1970s, it used to be the case that people who were non-participants in a particular week had been floating in and out of employment much more often than they did at the end. At the end, they are much more likely to be just 52 weeks out of the labor force. And that change, as you can see, was concentrated at the bottom of the income distribution, so that the bold line is the people in the 1 to 10th, first to 10th percentiles of the income distribution. And that bottom one that's basically flat is the people from 61 to 100. So it really has a lot to do with skills, and it has a lot to do with the wages that these people were being paid. Now, one of the things that,
Can you slow down?
Yeah.
To read it?
Sure, you want to take a look?
We can barely read it at the speed you're going through.
Okay.
No, I'm teasing. You're scrolling through the whole paper.
I'm not going to scroll through. I'm not going to show you the whole paper, Finest. So,
I've been trying to read it. I thought you were.
I don't want. I have to say, this paper's got a lot of good old Finest stuff in it. It's kind of like there was Not quite sure where that variation's coming from, because you regress this on that and that on this and over here, and then, you know, and then take the residuals, multiply them together, hyperbolic cosine, and then you put it in a regression, and it's got a t-statistic of 900, and you say, wait a minute. Yeah, that's right. The left-hand side variable is in there somewhere. Okay. The point I wanted to make, however, is just that there's a lot of context that doesn't quite show up in here because so much of this is concentrated on people with particular types of skills, and they take the housing booms in these areas as kind of exogenous events. And in fact, there's discussion of a bubble, and I wouldn't, you know, in some sense, at least up until the mid-2000s, you might not want to think of these things as like bubbles. But when changes in policy made financing of houses so cheap and people could get a mortgage for 100% of the house, then you might start thinking about those as policy-induced bubbles. So the counterfactual was kind of, in my mind, what would have happened had that kind of thing not happened, but that the market fundamentals in so many of these markets were actually driving an increase in the demand for these people because the people at the higher end of the income distribution wanted better and nicer houses, and this was something for them to do. So I took the main message, again, of the paper as not so much documenting or explaining a new problem of non-participation. I think a lot of people have done stuff on that over a long period of time, but showing that changes in housing demand can actually mitigate some of the changes that would have affected people that would have affected people in this part of the skill distribution because of their other ongoing technological changes. But some of those technological changes were exactly the things that helped to mitigate that reduction in demand for people at the bottom of the skill distribution. Thanks.
These,
Go ahead.
these locations are all imputed.
Yep.
Some kind of auxiliary regression.
Yep.
Using a low-weak sky to impute.
Yep.
Non-work.
All the way up.
Yeah. So I don't know what caused the housing boom, or what causes these kinks. But if it has anything to do with changes in the way that credit was being handed out, so that, you know, the locations differed in the amount to which, you know, they were bundling these mortgages together and selling them off, my understanding of how that worked was that that was an increase in liquidity, not only to buy the house, but to buy the sub-zero refrigerator and the home entertainment center, and there were a bunch of home equity loans that maybe wouldn't have been given in the past. And so the same type of relaxing credit that increased the amount of bricks bought should have also been affecting a lot of manufactured goods. And so it seems like, you know, really, if you want kind of an instrument that's going to affect one and not the other, you'd want to focus on manufacturing goods that are traded on the world market and look for some type of world prices or something.
What we do in the paper this is one of the general equilibrium things you got to think about. Now, what this does is biases our manufacturing estimates downward, right? Because some of the manufacturing declines would have been even greater had it not been for this housing boom lifting up the refrigerators and lifting up the home equity thing. So when we start sizing, so some of in the paper we have these general equilibrium stuff. The migration I could deal with directly. We estimate that from the model. I could make assumptions and bound our estimates based upon what we assume the migrants are doing. For some of the other ones, like this one, which is a prominent one, it kind of signs which way our bias is going to be. And it basically says that the manufacturing effect on labor markets is even stronger than what we're estimating from some more structural story, because the housing boom that was temporary lifted demand relative to whatever else was going on in the world market, from competition from China or the competition, or, you know, increased innovation in these sectors, which might be related to the competition from China. So we think about that. I use it as a lower bound. as our estimates on the manufacturing.
But it proved to be temporary in the sense that
it always is temporary with these scales. So there's never been a time where I found where you've had like 30 to 40% movements in house prices over a short period of time that has been sustainable at a city level, a state level, even through any of the, big productivity demands in certain cities over a period of time.
It comes back
supply
to Al's,
adjusts.
It comes back to Al's point about stocks versus flows.
In the long run, I agree.
You're building off of where you are on the construction supply curve.
So I didn't show you a figure it's at the beginning of the paper, which is the share of employment in construction over 60 years, and that is essentially flat for men with less than a college degree at about 10 to 11%. It fluctuates around a little bit. From the late 1990s to the mid 2000s, that went up to 16 or 17%. Okay, which is well above any historical average we've ever seen over a long period. Supply adjusts, there was a demand, prices kind of get mitigated, we have an oversupply, and then it corrected right back to trend, a little below trend, and then back to trend shortly thereafter. So it looked like something was going on in the national housing market that looked very different than any of these periods before. And it's not that we haven't had demand shocks affect housing prices in areas. They always do. I mean, that's what theory says. They just happen to move at a much more low frequency, slower movement than we saw this period. So this period, I think, looks abnormal in the house price variation given the fundamentals we've seen relative to other periods. What?
Yeah.
More so toward the end.
But a lot of that's just.
2005, 2004, you weren't so
Yeah.
I agree. But then some of those other stories that were occurring in 2002 and the cheap credit from China was propping up housing demand even in places that were, places like New York and San Francisco and some of those places that didn't have that bubble component, where something really weird looked like 2004 where things accelerated. But even these other places, we have potential housing demand stories. I can't identify those.
Well, that was the low interest rate.
That's the low interest rates. Yeah, the low interest rates.
But if it was driven by a change in the income distribution,
we could test that, right? That's going to be testable. So let
me finish. If it was driven by that, then there would be a surge as the stock adjusts to the new income distribution, and it would be a temporary increase in demand in that sense, because you'd hit a new steady state replacement rate for the housing stock. But in that transition, there'd be an increase in demand for these guys.
That's what I was going to say. And differentially, given the variation in the skill distribution across space, because I'm identifying, there's two things. There's one is the price response in absolute, and the second is I'm identifying off the spatial variation in that. So when you interact the spatial variation, there's rich people around the country. And the differential response is going to be,
But even market fundamentals without the policy change would have generated patterns like this, is all I'm saying.
I don't think of the same magnitude that we would, based upon historical patterns.
Yeah.
I think
The magnitude.
And in places that have wrongfully arrested.
I've seen a study of Spain.
What?
I've seen a study of Spain.
Yes, very similar.
And the other result was that the young men dropped out of school and went to
Yes. Yep. So people have said that, yes, I know the people doing the stuff on Spain, you see very similar patterns. In Spain, it's like a souped up, it wasn't enough. Yeah, I don't know. Here you did find some in the local areas, even on the women. But
they weren't necessarily working
the associated, non-tradable sector.
The jobs of the guys who moved in construction.
I have a problem that you might be able to shed light on for ages and ages. In cost-benefit analysis, we are typically looking forward many years at a time. And we always make the assumptions of long working market mechanism and which of the employment level means sort of full employment. And that means that if our project is creating 1,000 jobs, that we don't have any figure for unemployed being absorbed by this thing. So let's say with full employment, you create 1,000 jobs, you don't get any absorption. Now, we all agree that in Spain today, in the United States, in the Great Recession, Greece today, 300,000 jobs, you're going to enjoy and employ quite a lot of them. But we have a lot of skepticism that certainly when we've got 7.3% or even 8 or 9% unemployment in the economy, 300,000 jobs, we're not going to absorb 1,000. And we're probably not going to absorb 500 and probably not even 300 unemployed. Your analysis covers periods in which we have relatively boom conditions and somewhat recessive conditions. And Bob's analysis covers a long span of time in which we had quite a few ups and downs. Do any of these things show light on how this factor of absorption of unemployed varies as you create jobs in the economy of a different overall unemployment state?
I have not done anything on David. Have you done things? I think the things we're thinking about is a separate, different question, which is how do you absorb workers in a sense where the demand for the skills that jobs are being created aren't exactly perfect substitutes with the skills that the workforce has, and what is the elasticity of substitution of unemployed or displaced workers with the jobs that are being created. You're talking about the temporal variation of how that kind of varies over the business cycle, and I have not.
I'm thinking about any one piece of time, how what fraction of the jobs that are created in that piece of time are people who are shifting from other employments to you, and people who are coming from out of the labor force to you, and people who are coming from this unemployed state.
I do not know the answer to that. I don't know if people have.
I think we did anything on how it varied.
Very temporally, right.
We kind of had some gross numbers overall, but I don't think we had anything about.
What time, I mean, isn't there during short modern adjustments? I'm not sure what time.
We looked at kind of regional frequencies, which is like, you can think of those as mostly like 8 to 10.
Yeah, medium run, medium. Yeah.
They're kind of, regional stuff tends to be kind of medium term.
Yeah.
But I don't think we broke it out, like, is that, I think the interactions are bigger or smaller when the economy's tight versus. I think we had some graphs.
Jason's looking something else. Do you know the answer, Jason? I don't want to call you when you're thinking of something. But it was just basically about worker flows from unemployment to employment, how those have shifted over time in the time series. Do you see transition paths of the trend? Yeah, or cyclical variation, or
there's a little bit, but not as much in, say, the layoff rate or any kind of measure of separation or outflow. In the outflow, we see kind of a secular decline in overall turnover. And let's say the job finding rate, there's a little bit of a secular decline, but really there's just a huge jump in cyclicality. And in this period, it's just flat. It's close to flat.
There's a bunch of people working on the worker flows and see how those things can, I think so. It would be more than that.
All right, well, we run our 10 minutes. Oh, we got a quick question. We run our 10 minutes over.